Happy New Year. It's great seeing all of you again. I should have updated my bio. Actually, in February 1st, it was my 26th anniversary with the LA County Assessor's Office. So I've been 26 years. But, former Assessor Rick Arbach appointed me, and current Assessor John Arnoguez has kept me on as a special assistant in his executive team, and so I am really honored to be able to continue making presentations to you, realtors, and to various community groups. And what I have today to share with you is an update on misfortune and calamity. As many of you know, back in December of 2011, we had these really, really severe windstorms, and some properties were badly damaged. Trees fell on them, the house, broke in half, and there were other property damages. So what we are trying to do is issue an important public service announcement regarding wind damage, because if you suffered, or if the property owner suffered $10,000 or more in damage, they could complete an application, which is a reassessment of property damaged or destroyed by misfortune and calamity. They could get a temporary tax relief due to the damage. Of course, we would also need copies of the contractor's estimates, pictures to substantiate the damage, and the property owner would have 1 year from the date of damage to file for this misfortune and calamity. Now, this doesn't just apply to the windstorm. If a house burned down due to a fire, they can file for misfortune and calamity. If they suffered damage due to an earthquake or a flood, they can apply for misfortune and calamity. But again, there is a time limit to do so. So it's very important to keep track of that. I have a couple of applications available if you wanted to take some. We have the flyers available as well. The information can also be downloaded from our website. So that's with the wind damage. Now here's an update regarding the decline in value. Our department is now gearing up to start doing the review for the declines in value. Last year in 2011, we reduced about 475,000 properties, single-family homes and condominiums. Now, once you get that decline in value, it's only a temporary decline in value, it's not permanent. So by law, each year, we need to review to see if the market has changed. So as of January 1 of 2012, that's the value that we're looking at. When we start a review, it's called a restoration program. So we're going to look at what the fair market is as of January 1 compared to the trended Prop 13 value, and also look at what the current Prop 8 value or the decline in value is for that particular property. Now, if the market has continued to go down, we'll make the adjustment. We may reduce that value further. If there has been no change, we will leave that temporary lower value alone. If the market's gone up, then we'll make those incremental increases in value. And should there come a time when the market has fully come back, we will restore the trended Prop 13 value. Basically, we'll restore it back to where it would have been had they never received a reduction in the first place. So it's always important to remember that the decline in value is only a temporary reduction, it's not a permanent one. Now back in the 90s, I've seen properties back in the 90s when we had that major recession back then. I've seen properties that had a decline in value from 1993 through 2003. They had it for 10 years. But then in 2004, when we restored their value, they had sticker shock. They thought, oh my goodness, the assessor's office has just reassessed my property. We had to explain to them that what you had was a temporary decline in value. Now that the market's come back, we restored your trended Prop 13 value. So you benefited by paying less taxes for the 10 prior years, but now we're restoring that value and you'll be paying your fair share. And our job is to make sure that no one pays more than their fair share. So we want to help homeowners keep their homes. We want to help them stay in their homes. And if warranted, if making that reduction helps them, then I think it's really a good thing. And you as realtors, it's important for you to know about this program and to be able to share that information with your clients. And also we have the information on our website. Last year we enabled people to be able to file online for that decline in value. Now for 2012, the filing period begins June 1st and November 30th. With the Assessment Appeals Board, which is another agency, another department, they handle the appeals. Their filing period is July 2nd through November 30th. Now last year, we granted an extension to the decline in value filing deadline with the assessor's office. So we granted that extension through December 31st, 2011. But that was just our extension. That did not extend the appeal filing deadline with the board. Theirs still stayed at November 30th of 2011. So any questions regarding Prop 8s or actually declines in value? Okay, great. Now let me talk about information on the death of a property owner. This is the beige brochure that I have up there. I didn't bring that many, so if people need copies, I'll be more than happy to send a stack to the office here so that you can always pick them up. But basically, death is a change in ownership. Even if the property is in a trust, if the owners of the trust pass, it's a change in ownership. Now by law, if it's in a trust and the owner dies, we're supposed to be notified. The assessor is supposed to be notified within 150 days of the passing. And how are we notified? The trustee or the executor would need to file a change of ownership statement, death of real property owner. That application can be found on our website, assessor.lacounty.gov. It's under the forms section. Now in our brochure here, we have a checklist of the materials that we need. So if the property is held in a trust, we would need the change of ownership statement, death of real property owner. We would need a copy of the entire trust, including all amendments and attachments. If the beneficiaries of the trust were the children, then we would need a Prop 58 application. And that's really important because oftentimes the children are the beneficiaries, but they say, well, the property's still in the trust, there's no change in ownership, we won't do anything. Later on, 3 years, 4 years down the line, the children decide to sell the property. What happens? That's when we find out, oh, mom and dad, they passed away a few years ago. Now it's sold to a third party. What we will do is we will go back and reassess to the date of death. Because it's already sold to a third party, we will issue unsecured tax bills for the escape assessments for the years from the date of death to when they sold the property. Now, the children, if they are the beneficiaries, they would only have 6 months from the mailing date of the notice of assessed value change to file that Prop 58 application. They only have 6 months. If they miss that 6-month filing period, they will be responsible for paying those unsecured tax bills, the escape assessment. Normally, if they had kept the property and then they find out later on, oh, yeah, they would qualify for that parent-child exclusion, they would have 3 years to file, and we would go back, make it retroactive if they were within the 3 years, or even if they missed a 3-year deadline and they still filed maybe in the 4th or 5th year, we would still grant them the Prop 58, but it would only be valid from the year they filed forward. But kind of going back to that date of death example, so if the kids miss that 6-month filing deadline, they're responsible to pay, or the estate or the executor, whoever's named on that bill, is responsible to pay for those escape assessment unsecured bills. If those unsecured bills are not paid, they will become a lien against the person named on that bill. So what will happen is that once it becomes a lien, it may end up in someone's credit report, and it may affect their ability to get credit or apply for loans. So it's really important that they know what they need to do. And that's why when I talk to my senior groups, I always tell them, I know you guys all own tons of properties. You have your estate in a trust. Wonderful. But please make sure you have a copy of this brochure and a copy of the blue brochure, which is the Prop 58 for the parent-child exclusion, so that upon your passing, your executor will know what documents to submit to the assessor's office. Now, what happens if you miss the filing period or the filing deadlines for notifying us? Under the law, you may be penalized for not submitting that change of ownership statement in a timely manner. But in my experience, I haven't seen us charge that in this particular situation, but we can do so. So that's why it's really important to understand death of property owner, the responsibilities, and just understanding that it is a change in ownership even if the property is held in a trust. Now, what I'd like to also now talk about is the Senior Citizens Replacement Dwelling Benefit. And this is basically a refresher course for many of you. But for the Senior Citizens Replacement Dwelling Benefit, if you are 55 years or older, you can sell your primary residence and acquire another primary residence of equal or lesser value, apply for the Prop 60, and we will transfer your trended Prop 13 value from your original property to your replacement property. Now, it's very important that you meet the requirements stated in the law in that the replacement cannot be more than what you sold the original for. However, if you sell the original, let's say year one, you sell the original for $500,000. If you buy the replacement within the first year of the sale of the original, there's a 5% inflationary factor that is built in. So you'll have 5% to work with. 500,000 times 1.05. So if you buy the replacement within the second year, it's a 10% inflationary factor. So it would be 500,000 times 1.1. But if you go over that amount, that Prop 60 application will be denied because you do not meet those requirements. It has to be within those guidelines. If you buy the replacement first before you sell the original, there's no inflationary factor built in. So if you buy that replacement for $500,000, you will need to sell the original for $500,000 or more. Now you have 2 years before or after the sale of the original to acquire a replacement property. If you miss that 2-year deadline, that replacement will not qualify to have a base value applied to it. Now, an important thing to know is that some people may own duplexes and they live in one. So they'll sell their duplex and they want to find their replacement property. But the thing is that if you sell your duplex, let's say $1 million, that does not mean that the senior can buy a replacement for $1 million. They will only get the portion that they resided in. So if it's a duplex, and let's say, to make it simple, it's 50-50, their replacement can only be $500,000. They will not get the full advantage of the $1 million because they didn't occupy both units. They only occupied one unit. Now the replacement needs to be a single family home. So if they buy a duplex, they'll need to make it so that it's a single family unit because the law says it needs to be a single family unit. And the filing deadlines for Prop 60 is 3 years from when you acquire the replacement property. So you have to buy the replacement within 2 years of the sale of the original, and you have to make sure you file for that Prop 60 within 3 years. What happens if they miss that 3-year filing deadline? Can they still apply? Yes, they can, but similar to Prop 58, it will not be retroactive. It will only be valid for the year they filed forward. So that's with the Prop 60. With the Prop 90, it allows a person to acquire a replacement property outside of the county they reside in. Currently, there's only 8 counties that have a Prop 90 ordinance in place. You should check our website because that's where we keep the updated list of counties there. It's not in our brochures because counties can opt in or can opt out. A couple years ago, we only had 7, and just last year, a county decided to opt in. So that's why before you buy a replacement property in another county, please be sure to contact that assessor's office to make sure that they have a Prop 90 ordinance in place. Now, what I'd like to talk about are supplemental taxes. Supplemental taxes are a one-time bill, usually due to a change of ownership or new construction. So let's say the original value was $100,000 and someone buys a property for $400,000. That's a $300,000 increase in value. Now, as of January 1 of 2012, the assessed value is $100,000 and it subsequently sells for $400,000. The property owner will get a supplemental bill for the difference in value. Now, our website, we have a supplemental calculator there. Now, I'm sure all of you have visited our website, right? You've checked out our supplemental calculator and you've used it, or you've told your clients to go there to use it and to plan ahead, because supplemental taxes, if you have an impound account, they're not sent to the lender. They go directly to the property owner, so they are responsible for the supplemental bill. And our calculator will let you know, or at least comes really, really close, on how much money they should anticipate having set aside to pay those supplemental bills. Now, with new construction, it operates the same way. Unfortunately, the calculator won't work for new construction. So if someone adds a second story and we increase the assessment by $100,000, they'll get a supplemental bill for the $100,000. So 100,000 times 1.25%. Do the math. It's what, 1,025. So they'll get that bill, and actually it's $1,250. I'm sorry. So they'll get that bill. They'll pay it. Now, if they disagree with the assessment that we've enrolled for that new construction, they can contact the district office and speak to the appraiser, show them the receipt, show them the contractor's cost, and we'll take a look at that. And we can always review the assessments. Or even when there's been a change in ownership, if we enroll a value that the property owner does not agree with, please contact us, explain to us why, for example, even though the market value is at $500,000, why you only got to pay $400,000. You know, what was the condition of the property? Was it in really, really bad condition? Did the previous owner trash it? I know in today's market, many times in these short sales and foreclosures, the properties may be left in very bad condition by the former owners or a former tenant. So we need to know that, because that explains to us why the value of the sales price would be a lot lower. Because please understand, in distress sales, we do not automatically accept the reported purchase price. So if it's a foreclosure and the property sells for $300,000, but the fair market is really $400,000, we're going to enroll the $400,000. But you know the market best. If you know that, well, you know, this foreclosure was listed for months, it was there for a year, no one wanted it. This was all that we could get for it. So let us know. We'll take a second look at what we've enrolled, and if warranted, we'll make the change. We're not perfect, we make mistakes too. So please let us know if you disagree with the assessments that we've enrolled. Now, I'd like to open up this time for any questions. I know before I got here, people were already asking questions, so I'm anticipating a lot of questions from you. If you can go to the mic, but you can... Can
you name the eight counties for Prop 90?
Okay, for Prop 90, I'll do my best here. There's LA County, San Diego, Orange, Ventura, Santa Clara, El Dorado, did I say Alameda?
No.
And...
what was the new one? What was the new one?
I believe the new one was El Dorado. I know I'm missing one more.
How about San Bernardino?
Oh, I'm sorry. San Bernardino and Riverside opted out years ago, so they're not part of the 8. So I would go and check our website. So at least I named most of them. Okay. Yes.
Hi, my name is Margaret. I have a case. It's a senior citizen. He owns his property, but now he wants to sell his property and move with the daughter, has to buy a new house here. So can he co-own a new property with the daughter and still qualify for Proposition 60?
So the senior, of course, he's 55 years or older. He's going to sell his primary residence and acquire another primary residence with his daughter. But the thing is that we can only look at what he sells his property for. So yes, he can own it with his daughter, but the value of the replacement has to fall within the guidelines of Prop 60. So we're only going to look at what he sold his residential property for. We're not going to look at if the daughter had a property also and she sold it and combine it. We can't do that. So we're only going to look at the father's sale of his original, and then the father and daughter can buy the property together, but the father has to be the claimant. He can only be the claimant.
Yeah.
Okay. So he can go ahead.
And when you mention the single family unit, is condo or PUD will qualify as a single family unit?
Condominiums will qualify.
Okay, thank you.
Vince Veneziano Realty. On a reassessment, if somebody paid already the property tax and then file for the Prop 8, which took over, and they have been granted, you guys have funded the money?
If the taxes have been paid in full for the annual bill and we subsequently enroll a decline in value,
yes,
they will be refunded the difference. Yes.
Tony Tavakan from Kotai Realty. I have a question regarding replacement home. If you bought it before you sell, but you rent it out, after you sell, can you go back and live in the rental as your home and apply for the property? You bought it but rent it out.
You bought your replacement property
Before you sell it.
but you rented it out before you sold the original.
After you sell, can you move in and apply for that? Yeah.
I have to think about it. It's kind of a lot to think about. I have to put it on paper, but it sounds like as long as you still have the original, you have a homeowner's exemption on your primary residence and you're still there. You just happened to buy the replacement first and you rented it out. Well, you have 2 years to acquire the replacement before the sale of the original.
If we do it within 2 years, can we just have exemption?
I can check the BOE's FAQs on this. It sounds like you should be able to, but let me just double check. I think, yeah, let me just double check on that.
Good trick question.
That's a tough one.
Carol Quan. I have a question that's probably outside your area, but I'm hoping you can answer it. Out of every dollar that the tax assessor's office assesses on the property and the tax collector collects, how much comes back to our community? If there was $1,000 in taxes collected, how much would the city of St. Gabriel get from that $1,000?
Now, each city has their own, there's a formula on which each city will get, and that is an auditor-controller question because they have a list of the amounts or the percentages of the taxes that each city will get. There is a formula available, but I don't have that and I don't have the answer.
Who do I go to, the controller's office
You would need
website?
to contact the auditor-controller's office.
Thank you.
Yes.
Good morning, Carol, Yolanda, and actually I have a few questions. The first one, pertaining to Proposition 60, you mentioned from the time that they sell, they have 3 years for replacement equal or lesser value. Is it, or 2 years?
2 years.
2 years, I'm sorry.
But they have 3 years to file.
To file, I'm sorry, that's correct. Okay. Does it ever work in reverse? I have a client who sold a senior citizen, both. They had a 2-story home, but because of their age and their condition, they had to purchase a 1-story home. They have not yet sold their original 2-story home, but they've already closed escrow on the single-story home. When they get ready to sell this first property, this two-story home, does it ever work in reverse?
2 years.
Same
As long as
thing?
it's within 2 years.
So it can also work in reverse if they buy the home first before selling their
Right.
home
It's
with the
just
low
that
taxes?
they have to sell the original within 2 years.
Okay, okay, perfect. My second question, I get asked a lot on the property that's vested in a trust, say the mother does pass away, and you mentioned that Proposition 58, is that only if the successor trustee is a son or daughter, or the executor is a son and daughter, correct?
It's the beneficiary of
The
the trust.
beneficiary of the trust.
The beneficiary of the trust need to be the child of the deceased.
Okay, and then they have 6 months to,
If they've sold it to a third party, then they will only have 6 months. And it's 6 months, not from when they receive that unsecured bill, it's 6 months when the notice of assessed value change goes out. So it can be really quick, and that's also why it's important to make sure that the mailing address with the assessor's office is kept updated so that all notices will go out to the proper parties.
okay. And my third question, obviously right now because of the short sales and foreclosures, you mentioned closing on the higher tax amount. And I get phone calls, the title company and the closings obviously are still charging on the higher amount because even though they purchased it, and maybe the tax originally was based on 500,000 sales price, but because of a foreclosure or short sale, it now sold for 300,000. But obviously on the closing statement, the tax bill is still based on the 500, and that's what they have to pay at the closing still. They're asking me how soon do we get does a new buyer get the refund or adjustment of the correct sales price of, say, 300,000 now?
Okay, so let's say January 1 of 2012, the assessed value is $500,000. The annual bill that will go out in October of 2012 will be based on the $500,000. When the person buys a property, let's say they close at $300,000 on June 1st. They will get a negative supplemental or a check for the difference between the $500,000 and the $300,000, and they will get it as soon as we process that change in ownership. So we have work schedules, and we try to work them as quick as we can, but it will be an automated refund to the buyer for the difference. However, once they get that supplemental, that negative supplemental, we tell them cash it, don't spend it, use it to pay the higher annual bill, because they're still responsible for the annual bill on the $500,000.
Until it gets reassessed to the new 300?
The annual bill will not be changed. The annual bill is set it's going to be based on the assessment as of January 1 of the year. Any changes occurring after January 1 will result in either a supplemental bill for an increase or a negative supplemental for a decrease. So if it's a negative supplemental and you get a check for the difference, cash it and use it to help pay the higher annual bill that are still going to be due December and April of 2013.
Thank you.
Yeah, if you could please limit it to general questions. If it's a personal question, you can see her afterwards, okay? Thanks.
Thank you. Okay, it's only two. One on the trust, which if the husband and wife, if one pass away, will be no reassessment. The reassessment comes only when passing it to the children. When both the parents pass away, it's correct?
That's correct. When husband and wife own the property, they're in a trust. If one spouse dies, it's treated as an interspousal transfer, and that's not reassessed. It would be helpful if the surviving spouse would let us know by filing an affidavit of death of trustee, so that we can update our records to know that, okay, now there's only one surviving spouse. And when that surviving spouse passes, and if the children are the beneficiaries, then, the Prop 58 will come into play.
Okay. And the second one, which is a short one, it's on a transfer between the parents and the children, or grandparents to grandchildren. If you can explain on the way which When you're going from grandparents to grandchildren, it's only one-way pass and not the second.
That's correct. For the grandparent to grandchild, which is Proposition 193, it can only go from the grandparent to the grandchild, but the parent in between, who would have been the child, has to be deceased. So it can only, you can't just go, okay, mom can give to the kid and then the kid will give to the grandkid. You know, that's a step transaction, we can't do that. So the parent or the child in between has to be deceased in order for the grandparent to grandchild exclusion to work. Now with the Prop 58, it can go from parent to child or from child to parent. But 193, grandparent to grandchild only.
Okay, last question from the audience.